Hey everyone, welcome back to another episode of the Integrating Investor. I am Seth Levine of the Integrating Investor, as you guys know. Hey, and if you don't know and you came here by mistake, welcome. Welcome. I'd love to have everyone here. We're back live. It's nice to do a live show again. It's been a couple weeks. It's been a couple weeks since I've sort of been here. I've been able to take it easy. I've had, as you guys know, or if you don't know, then I highly recommend checking out. I had an awesome interview with Dr. Wes Gray of Alpha Architect. If you missed that, I think it was just phenomenal. We got into so many really deep topics, not really just about investing, but about thinking in general. Talked about biases, psychology. We really got into emotional intelligence in part two. As you all may or may not know, I call investing the act of selection. So it is a very thinking activity. So you cannot divorce these. You cannot divorce the two. Now, as promised, Wes actually answered your super chat questions. If you missed that, I actually posted them in the comment section of part one of the episode with Wes. That's where the question was asked, so you could find it there, and I'll go through it after this. So I thought today we are going to pick back up where we left off a few weeks ago. We're going to get into part 6 of our discussion of money, banking, and the Federal Reserve. More on the latter today. As always, please like and share this episode. Get the word out. Really helps right now. You're just sitting around. You got your finger on the mouse because where else would it be? Just hit that like button now. Just so you don't have to remember later and unlike it later. You can follow me on Twitter, Instagram. Check out the website. Subscribe to get my articles to your inbox. All that good stuff. And you ever want to reach me, you can fill out the contact form on the website, or again, email me at info@integratinginvestor.com. That's info@integratinginvestor.com. Now, moving right along here. So what I'd like to do for today's show is I'm going to answer the super chat questions from part one that we got. Give you maybe a recap of where we were before we in our journey of money and banking. And then today, what I'd like to do is touch upon what the Fed actually does. We talked a lot about money, a lot about central banking, about banking in general. And now we're going to talk a little bit about what the Fed actually does, kind of and mechanistically what it does, not what's assumed. I think there's a lot of discussion about that latter part, what we think the Fed can and cannot do. I'd like to just talk about what it actually does, and just look at that plain and simple, and then we can move on from there. Apologize for the noise outside. I am in New York City where things can get noisy and I can get distracted. I'm already checking out the super chat. Thank you so much. Thank you, MA. Great to see you. Thanks for the donation. Jonathan, always a blast to have you on. Thank you a ton. And thank you so much for your super chat donation. And hopefully you guys have some questions that come up, and I can make this a value trade. But of course, we got to start with our little disclaimer here. Don't want to qualify it. Let's just call it a disclaimer. These are personal opinions, not investment advice, not solicitation to buy or sell anything. Do your own work. Not going to be an issue for today's show, as we're not really even talking about investing. So, as promised, I would like to start off with our super chat questions. So, in part one, we had a question that was it has to be more than luck. Otherwise, why would it be so difficult? Such hard work. So this is a question relating to investing. Now, Wes's response was, I'm just going to read it. So these are all quotes. Possible, but self-attribution bias is the situation where one chalks up victory to skill and losses to bad luck. This leads to overconfidence and poor decision making. So for a mental hack, it's the key. One should chalk up victory to luck and losses to need to learn. This will lead to even keel confidence and more favorable decision making. So that's Wes's first answer. Again, go back to part one to check it out. The second question was, is quant investing adding math to formulas to investing? And Wes's answer, depends who you talk to. For me, it is simply systematizing your investment process / philosophy and putting rules around your decision making. Why do this? Well, we know our decision-making process in real time are prone to going off the reservation when we least expect it. So having rules in place can minimize their effect. So there you have it. I really hope that that helps. I believe it was I think it was you, MA. So I hope that answers your question. And again, feel free to let me know if not. So back to central bank and money and all this fun stuff. So we left off by really walking through how central banks don't make money, right? Money is production. Thus, only private banks can really make money, essentially. This is mostly done by the shadow banking system, which works around the central banks, right? We saw how bank reserves are completely unrelated to bank assets and inflation, which is what the Fed really professes to do. Of course, the central bankers actually know this. We saw in that Bank of England study, they basically say it plainly. And this is also why the Fed in particular doesn't target a quantity of money supply anymore. You think the central bank, their core function would be to monitor the money supply. Well, the Fed stopped doing that under Alan Greenspan because they couldn't even figure out they just didn't even really know what money was. It was getting too complicated under their, what I would call a misformed yet popular definition of money. So instead, they turned their attention to inflation, which is something that they actually could measure. Again, another kind of misformed concept, but we've talked about that already. So this is where we are, and this raises the question: if the Fed doesn't print money, what on earth does it do? Right? What does the Fed do? We all talk about the Fed printing money. What does it do? And importantly, should I even care as an investor? Right? Do I care as an investor if the Fed prints money or not? Right? What does the Fed do? Now, in my view, there's a link between the Fed, fiat currency, and elevated debt levels in an economy. And that's what we're going to begin to touch upon today. And it's all connected by a logical thread, which is cheap liquidity. And interesting, I came to this position really by integrating some disparate views on money and banking. I looked at an Austrian view. I looked at a Keynesian view. I looked at a new Keynesian view. I looked at monetarist view. Really, I looked at all these different schools of economics and what they said about money. And I kind of, I TOE'd it, right? I looked at the objectivist epistemology. I looked at their similarities and differences, and this is the conclusions that I drew. So what does the Fed actually do? The Fed has so many, mythical powers. We think the Fed can just do it all. They snap of a finger and they can do it. Well, really, it does nothing in my view, right? They don't create full employment. They don't create price instability. They don't really have this economic impact that is so fabled. They can't create credit. They can't really do any of that stuff. In fact, the Fed doesn't even create, well, we know the Fed doesn't create money, right? Only private banks do, right? In this definition of money as a unit of account, which I think is the right way to look at it. But the Fed doesn't even print money, as we commonly hear people complain, right? That actually, the Treasury prints money. They're the people in charge of running the printing press and then giving the money to the Fed to distribute. The Fed really is just a banker's bank. It only interacts with the economy. Its only touch point with the economy is through what are called member banks. These are private banks that are members, that are Federal Reserve members, and I'm not going to get into how that works, but they have accounts with the Federal Reserve. So these private banks have bank accounts with the Federal Reserve, hence it's a banker's bank, and the Federal Reserve interacts with the entire economy just through these banks, right? So we can see it's a very small touch point that it has. Everything else that the Fed can do, we already mentioned it, everything else is assumed. All the Fed can do concretely is interact with these member banks. So all the political and economic goals, the so-called dual mandates, right, for full employment and low and stable prices, or 2% price inflation these days. The only way the Fed can accomplish those goals is by influencing, or hoping to influence, is said better, private banks. And it does this by adding and subtracting reserves to the accounts that these private banks hold with the Fed. And this is what the Bank of England paper referenced in part 5 was talking about. This is the only touch point between the Fed and the economy. Now, the Fed has various tools that it can use to really accomplish this with. It has the Fed funds rate, right? This is the rate, the interest rate decision that we hear about. Interest on excess reserves, which is a little bit more complex and esoteric. We'll just put that aside, but it's basically just what it pays banks. And quantitative easing, which, as we've seen, has kind of exploded over the years. But really, this is where the Fed takes reserves, gives it to the members' banks. The members' banks go out and buy assets with it and give it back to the Fed. Notice in all these that we're really talking about asset swaps here. But there's nothing really new being created in the private economy. It's an asset for asset swap at the member bank level. The Fed is buying assets out of the economy with reserves that's essentially conjuring up out of thin air. So the Fed is taking reserve. The Fed is saying, I want to buy an asset. I want to buy a US Treasury bond. It basically goes to a member bank and says, hey, sell me a bond. The bank sells it a bond, and the Fed credits the bank's account with the so-called reserve, money in a sense. Now, these reserves are completely made up out of thin air, 100%. However, they're very useful to these commercial banks because they satisfy various leverage and liquidity requirements and regulations that they have. So these reserves actually play an important regulatory role. That's, even if the reserves themselves are artificial or not. But note, though, that from a bank perspective, from the economy perspective, whenever the Fed takes action, it doesn't change the amount of assets in the economy. It only changes what it looks like. For every reserve addition in the economy, so every time the Fed gives a bank a reserve, it's buying an asset in return, and vice versa. Whenever the bank subtracts a reserve, it's selling back an asset. So the banks need to purchase an asset in order to backfill that asset hole. So it is a net zero asset activity. Now, in a financial system that's dominated by collateralized borrowing, again, this is the shadow banking system, the reserve levels, that the Fed is doing is really just not that important, right? It's just not having a huge impact on lending, at least as much as it used to. It's very small these days. And just to drive it all home, I will reshare this that I did last time, right? This is from a study I brought up. that between 1981 and 2006, we saw bank assets rise, by 744%. Yet the reserves, these reserves that were on deposit with the Fed, they fell, right? So this just goes to show you how little an impact Federal Reserve reserves have in the lending economy, the lending and the real economy. Now, how is that possible, right? That just what I just said. I don't know how many people would really agree with that, right? Because we hear that the Fed prints money and the Fed creates all this credit expansion. Like, how could I say something so different? Well, luckily it's not just me. This is taking from someone else's, from Mark Dow, who I enjoy his work at times. And he points out that was true. The Fed and central banks really were important for credit creation at one point. However, that's no longer the case, right? There's been a structural change in the economy. That money is now created by the private shadow banking system, right? Let's look. This is answering how doesn't the Fed create money? The answer is structural. The financial deregulation that began in the early 80s, which significantly the abolition of Regulation Q, and the consequent development of repo markets fundamentally changed the transmission mechanism of monetary policy. Collateral lending is now king. Today, length of collateral change and haircut rates, neither of which are determined by the Fed, define the upper bounds of the money supply, not base money and reserve requirements. In other words, what the private banking system is doing in that shadow banking system is actually depending the quantity of money in an economy. So just give a quick pause there, let that sink in, and check out the chat for a minute. MA, thank you again. We are emptying your pockets today. I really thank you so much for the donations again. I am not in awe of the Fed. I am not in awe of the Fed either. I guess it depends by what you mean by that in terms of how powerful they are. I share your view. I think it's more fiction than anything else, or it's an antiquated view. But we'll see. It's not that they have no impact. It's that the myth of the Fed, how much of an impact that they have, I think is really overstated. So, it's not, so leading right into that, the Fed, it's not that the Fed is unimportant, right? I think this is an important point, because I do think the Fed does play a role in the economy and markets. So it's not unimportant. I just think it's significantly less and different, importantly, than how most people assume. The Fed is just another market participant, albeit it's a large one, and it has very different motives than how normal sort of investors, economic actors act, right? They have policy goals. Now, what do I mean by that? Well, let's look at the Fed fund rate, for example, right? The so-called policy rate. This is what the Fed sets during its meeting. Well, this is an actual target rate that the Fed puts out there, but it is actually a market rate that is determined by banks transacting in the money markets, in the financial markets. So the Fed sets this via what's called open market operations. Now, due to the various, regulations and vagaries and how it all works, the Fed, in order to set this Fed fund rate target, they don't just say this is the target rate. The Fed goes into the marketplace and actually buys and sells short-dated U.S. Treasury bonds in the open market. These are bonds that are, or Treasury notes more specifically, that have that there's an arbitrage there for the banks, right? They satisfy the similar liquidity and regulatory needs, so they should trade about the same price. So when if the Fed funds market is if the Fed funds market is not where the Fed wants it, they go into the open market to change the rate, right? They don't actually change a rate by decree. They go into the open market. So that Fed funds rate actually only holds due to regulatory arbitrage. Just to show you what I mean a little bit, we're getting a little bit specific here, but I think we should be able to follow along. Here are just some money markets. We'll see the blue is the effective federal funds rate. That is the actual Fed funds rate that banks are transacting at, not the policy rate. I put 3-month LIBOR on there and a 3-month Treasury bill, right? These are just rates that are all more or less fungible with each other. And what you can see is, for the most part, they all move in lockstep, right? They're all very well correlated. However, divergences do occur periodically. And they occur because, again, we're talking about a market, and markets are messy. So the Fed's mechanism with the economy, at least from the Fed funds rate perspective, is really only on short-term rates. And it's because of the arbitrage that exists in between the banks and the markets. What about other bond rates, right? And security prices, right? We hear the Fed creates bubbles, the Fed, of all sorts of securities. Well, here's another piece of research that I will share with you. And really, quite honestly, as you move away from the short-term rates, you go longer out on the Treasury curve, you move into other asset classes, the relationship between the Fed funds rate and these other asset prices get very complicated. This is a Fed study that I'm citing here that says a hike in the Fed's policy rate will directly impact rates on short-term treasuries, right? Which we know, but the effect on long-term treasuries is less predictable. So even the relationship between Fed funds and long-term treasury rates are not so straightforward, right? And these are closely related things. These are just treasury bonds of just different maturities, let alone getting into different types of bonds, different issuers, stocks versus bonds, all sorts of, derivatives, all sorts of things. Well, that's on the Fed fund side. What about quantitative easing, right? This is the Fed bond buying program, right? There's a very strong belief out there that quantitative easing created a stock market bubble. Now, that was my initial belief too. I really thought the Fed was going in there and creating a bubble. In fact, that was, I think, my first article that I published on my blog, right? The integratinginvestor.com. But, since then, I've reversed course on all this. Because, again, I just look at what the Fed actually did, right? What did the Fed do in that first instance of quantitative easing? Well, it took $4 trillion of reserves, right, out of thin air. It gave it to banks in return for U.S. Treasury bonds and mortgage-backed securities. Now, markets are complicated, complex, and integrated. So, of course, there were some secondary effects from this this bond buying program, but it's really hard to be so certain about specific effects. Right, here's an example too that I like to think about. Now, this is dated. This is from the Felder report. If anyone knows Jesse Felder's work out there, I think it's pretty good too. But it just shows how complicated how complicated market prices are versus what we give them credit for. Now, the blue here is going to be equity valuation, right? Just one way to look at equity valuation. So higher is more expensive, lower is less expensive. And we could see that, recently they've gotten very expensive around 2000. This is the NASDAQ bubble. And we could see the run up here. This is, I believe until 2018 or something like that. We could see how equity prices got more expensive. What's also shown on this slide, though, is stock buybacks, right? During this modern period, corporations have bought back an enormous amount of their own stock. Now, if a company is going to buy back its own stock, that's going to help drive the demand for the stock up, which is going to help drive up the valuation. So to quote Jesse Felder, the total amount of stock bought back by companies since the 2008 crisis even exceeds the Federal Reserve's spending on bond buying over the same period as part of quantitative easing. Both pushed up asset prices. Right, so maybe the Fed and QE had an impact, but there also was this other impact of massive share repurchases that are acting on stocks. So do we really know how much we can attribute to the Fed and how much we can attribute to other factors? Now, there's no question that today the Fed is even more involved in the economy and markets than ever before. I mean, just a year ago, it started buying back corporate bonds and stock ETFs and all sorts of stuff. Now, it's important to note that the Fed, in doing this, is participating in the market demand for those products too. So it has a market impact on this, but it's just a market impact. It's no different than if a large institution or you or I really wanted to go and buy and sell those securities. It has a marginal impact on price, and that is important, but that is all it is. The Fed cannot control the prices for any of these markets. It can only act as a participant. So let's keep this perspective, right? The Fed is basically all carrots and no sticks. It can't mandate anything. It can't print money. It can't ease credit conditions, and it can't dictate prosperity. At best, all the Fed can do is incentivize the activities of private market participants by creating profitable arbitrage opportunities within certain bond markets. True, these can be motivating, but they cannot affect outcomes. Individuals still act individually according to their own value judgments. Now, I think it's really telling that the Fed and really other central banks for that matter, they've all failed to achieve their stated inflation targets for well over a decade. Now, to me, that just speaks how little power these central banks actually have in the economy, right? Why is it so hard for them to hit these inflation targets? Now, in my view, the Fed does have an economic impact, right? These reserves are important, and the price of these reserves are important. It is basically the cost of capital for member banks. And to a smaller degree, again, because of the arbitrage, it also impacts the cost of capital in the shadow banks. Now, note that these reserves are not raw material for lending, right? These banks hold reserves really for liquidity and regulatory purposes. Now, think about that in the context of our carry trade. If you remember, we talked about banking as a carry trade. Banks borrow to lend, and they earn the spread or the difference between what they lend and what they borrow, right? It's basically free money if you can manage it right. So if you impact the cost of borrow, right, the cost of your capital, that's going to impact your lending rate. So that is where I see the Fed impacting the economy, is that they impact the cost of capital for liquidity for banks. And this is just incredible. Now, this is important when we think about banking as a levered carry trade. And in my view, the key to understanding how the Fed impacts the economy and investment markets. So to sum it all up, right? Sum up this episode as we're on the half hour mark. The Fed is just a market participant, but a large one, right? It can't bring forth anything by decree. It really just plays a limited role, although expanding, in this, as a buyer and seller in a limited set of financial markets. So it affects the supply and demand for various securities throughout time. The Fed's importance in today's economy, however, is significant, even with all this intervention, is significantly less now than ever before in history. And this is because of the shadow banking system. The Fed impacts the real economy by the cost of carry for financial institutions, right? Whether it's the member banks directly who actually fund themselves at the Fed funds rate and through the arbitrage situations, or the shadow banks more indirectly via kind of how all the short-term rates and money markets interplay with each other. And this has important ramifications in my view. And it becomes very clear when, again, thinking of banking in our carry trade framework. What this does, in my opinion, and what we'll see, I believe, next week, finally, is it creates higher debt levels in economies. So with that, I will wrap up this week's episode. And I will, let's see what's going on in the chat. Again, everyone, this is a great time now. Last call for the chat. If you can, like that show when you're at it, if you liked it, or, unlike it if you didn't. And let's see what we have. So MA, again, thank you for your donation. And thank you for your question. Where does the government get the money it keeps handing out? It is borrowing money. Now, there are two schools of thought here. It's a very complicated question, right? There are two schools of thought, I should say. The first school of thought is maybe the traditional school that says the government borrows money, right? This is the U.S. borrowing framework. And there's the new MMT framework. It's really not new at all. It's just rebranded as modern monetary theory. It says, well, the U.S. government, because it prints its own currency, it just prints its money into existence. Now, both are kind of true, right? And don't really get too many people saying that, right? We live in a fiat currency world. The U.S. government really can just print money into existence. So it would be the Treasury kind of printing money to the Fed, or the Fed actually, well, there's two things. There's money and there's bank reserves. So I already confused the two there. Let's just talk about money first. There are many who say the U.S. government, any fiat currency regime, just prints money, via the printing press, right? We literally just run dollars off the printing press, given the people, and the government buys what it wants. And that is true. However, why does the government borrow money too? And now, to me, that is an indication that there is a connection between money and the real world. And that is what I was trying to get at in some of the earlier episodes, right? Money is production. You just can't print money into existence or currency into existence in a disconnected way from the production in a real economy. Those, in my view, are what happened during these hyperinflation scenarios. The Weimar Germany, Zimbabwe, and the such, those classical hyperinflation scenarios. So there is a connection between even fiat currency and real production. There has to be, otherwise currencies have zero value. But the money that the government is just handing out, it's basically either borrowing or printing. They're both doing the same thing in a sense. Because if the economy doesn't catch up with the borrowing base, that's where we're going to have problems. And that we haven't really seen yet. But again, these debt loads that we're seeing are really a post gold standard issue, right? The amount of debt in the U.S. economy to GDP really hasn't been this, well, it's never been this high ever. but it really exploded in the post-welfare state economies coming off the gold standard. So it's still relatively new, and we'll see. Now, the Fed gets its reserves, right? The money that the Fed has to play around with, it literally prints out of thin air. If I'm a bank and the Fed says, "Hey, Bank of Integrating Investor, I want to buy a billion bonds, $1 billion of bonds from you," and I say, "Okay, I have $1 billion of bonds that I've bought from my customers. I'll give it to you." And the Fed says, "Thank you for the bonds, and in return, check out your bank or your bank account with us. We just put $1 billion of reserves in your account. Thank you very much." And as a bank, you say, "Well, thank you, because these reserves, they actually satisfy some need for me. So they are not worthless in a sense. If they'd be worthless really to anyone else." Does that make any sense? I hope that helps, MA. If anything else out there, which I don't see, I hope you guys are enjoying this. Hoping to wrap up this whole money Fed discussion. It's been a really long journey. It's been complicated. I hope everyone is able to follow along. There is a pretty long logical chain here that I'm trying to work off of, and I hope that's apparent. And if there's nothing else, it is a gorgeous day here in New York, where I am. I hope it's gorgeous where you are too. Looking forward to enjoying the last days of summer here, starting the football season. And I will see you all next week. Have a great weekend, everyone.